How worried should you be about interest rates? That implies that you should have some degree of worry. This week on the Property Podcast, we talk about interest rates. I'm Rob B with Rob D. Let's get started.
Yes, welcome to the podcast. It's going to be a good one. It might seem like a bit of a dry economics kind of topic, but if you're thinking that, I think you might be pleasantly surprised. And even if you do find it a bit dry, it's very important. Interest is going to be the largest single cost for most property investors, therefore something you should know about, and we're going to be telling you everything you need to know over the course of this episode. We're also going to be giving you a news story, a resource, all the usual good stuff. But first, a quick mention that tonight is Meetup Night. It's the first Thursday of the month. And when it's the first Thursday of the month, that means that property-loving people in 40 locations around the UK and beyond get together to have a drink and a chat and to share information. They don't get sold anything, they just do it because they love it. So it's all happening tonight. Rob B is down standing in as the leader of the King's Cross Meetup. I'm up in Edinburgh for the rebooted meetup up here. So if you'd like to get along to either of those or any of the 38 others, just go over to thepropertyhub.net/meetups. Book your place. It's free. All you need to do is register and turn up. Dead easy.
It is easy. Another thing that's easy, Rob, is writing a book. Oh no, that's not easy.
No, it's really, really not. Actually, writing it isn't that hard. Finishing it and making all the final little tweaks is really hard. And that's what I've been doing. It comes out in just a few weeks. The 26th of April is release day. I've said it now. It has to be. And this week I've been collating some of the feedback from my lovely advanced readers who've been kind enough to go through it and point out all the mistakes I've made, which I'm sort of simultaneously very grateful to them for and a bit resentful because it's given me lots more work to do, but it's making the end product much better. And we've also been having a little cheeky look at the front cover, haven't we, Rob?
We have. You brought me in at the most important stage, how to make it look pretty. I know where my strengths lie. But yes, it looks very good. It looks very good. And I've not got my hands on a copy yet, but I know a lot of what's going in there, and I'm really excited about this book. This book's needed. You know, it's not trying to carve out a space for this book and like, where can we find a book and a subject that's needed in the market? It's almost ridiculous that this book doesn't exist, certainly in the way you're putting it together anyway. So very excited to see this one go live. I wouldn't be surprised if it's your most popular book yet. We'll see. But what I can assure everyone is it's got a very nice front cover.
You made sure of that. So, yep, that's what I've been up to. But I'll be taking a break to have a drink with lots of nice people tonight in Edinburgh. And also revelling in the fact that as property investors, we are in very good company, not just with the lovely people at Meetup, but also in the company of one of the richest men in the world.
Yeah, so Warren Buffett, not known for his property investments, very much known for running his investment company. Worth billions, but he's not ignored property. He's done all right there too. So the story that we have in this week's podcast, which you can find in the show notes, which this week are at thepropertyhub.net/interest rates, tells us how Warren Buffett, said to be worth $74 billion, wow, back in 1971 acquired an investment property for $150,000. 46 years later on, it's worth $11 million. You can't do anything wrong, this guy. Now, yes, that is 46 years. But however, that's definitely inflation beating. And it just shows you that he still holds stuff for the long term in property too. So he's famous for taking the long term approach to the stocks and shares and the investments he makes. But it seems he very much is taking the same approach for his property investments. Not known for that, so that's why we bring it to your attention. But it's interesting that he's applied the same long term approach, that same discipline to property as well.
It is interesting. And interesting also that you mentioned inflation, which is very much tied into interest rates, which is the topic of the week this week. How worried should you be about interest rates? Well, it's a question that lots of people are asking, but somebody who's actually specifically asked the question and recorded it and sent it in to us is Alistair, and he inspired this week's episode. So let's have a listen to Alistair's question.
Hi, Rob and Rob. My name's Alistair Cumming. Enjoy your show. Find it amusing and interesting. My question, and you may not want to treat it as a question because it's probably enough in the question to make a separate program on it. And my question regards interest rates. Currently, I can make a reasonable amount of profit, and I think it's not too difficult to make a reasonable amount of profit in the right location and get a positive cash flow. But all that relies on is low interest rates. Now, low interest rates are historically low. Before 2007, they were 5% on average, and before 1995, they were 10% on average. Is this just a waiting time bomb which could scupper a lot of businesses? Looking forward to your answer. Hear from you soon. Thank you.
Well, Alistair originally submitted that for Ask Rob and Rob, but as he said, there's probably enough there to make a full episode from it. And there is, so we have. So we're going to talk about a lot of the what-ifs and the whens and all that kind of thing, but let's start, Rob, with a little bit of a history of interest rates.
Let's. Although, Rob, I can't believe you said this potentially could be a dry topic. Economics, that's like one of my favourite pub conversations, up there with the HS2 and other infrastructure projects. And I can't think why people won't go to the pub with me. Right, okay, so let's have a look at the history of interest rates. So the long-term average of interest rates is around 5%. Would have liked to know what you would have guessed, but 5% is the number. Now, back in 1990, they peaked at 15%. And for the rest of the 90s, they hovered between 6 and 7%. Then, in the early 2000s, they were dropped a bit, and the average kind of floated between 4 and 5.5%. But then, in 2009, dramatic things happened the year before, and interest rates were slashed. And they went all the way down to 0.5%, until obviously they couldn't fall any further until last year, and went further to 0.25. So, average at 5, currently at 0.25. So, Rob, they are very low, but why are they so low?
Well, this is the big question. Why are rates so low? For a start, rates are low. If you don't remember some of this history, you might think that this is normal. It's not normal. Rates have been really low for a really long time. It's unusual. Why is it the case? Well, there's multiple reasons why this policy has been pursued. One of them is to promote consumer demand. So there was a big crash, confidence was affected, you need to get people spending, and obviously you're more likely to spend your money if you don't get much return on saving it. So that's one reason why rates are low. Another reason is that low interest rates tend to boost asset prices. And when asset prices are high, people who hold that asset tend to have a greater willingness to spend. So you'll see this in consumer terms from the fact that when people's house prices are high, they'll feel more wealthy and they'll go out and they'll spend more. Interest rates were slashed to kind of underpin asset prices, and then they've been kept there because they want that effect of making people more willing to spend their money. It's the same for companies as well. It's cheaper for companies to invest in growth because they can borrow money at rock bottom rates. And if we're being cynical, which I normally am, it's also cheaper for the government to borrow money and to service its own existing debts. So low interest rates have a number of benefits. Not saying that the current policy is right. Everyone's going to have their own view on that. We're not getting into that in this episode. We're just saying why a policy of low rates has been pursued for such a long time. And as I touched on, this is not normal. Rates are not generally this low, and there's a risk, therefore, that people are going to misunderstand interest rates and perhaps make some of the wrong decisions as they go back to normal.
People really do misunderstand interest rates. So, for example, people think, 2%, well, if it goes up to 3%, that's not much. Doesn't sound like much, but it is. Because, in effect, you've got a 50% increase. So you've been at 2, you go to 3. It's not a percent rise, it's a 50% rise. So if you borrow 200k at 2%, then your monthly interest payment is around £334. Okay? But if it goes to 3%, it doesn't nudge up slightly. It goes from 334 to roughly 500. That's a significant pound note jump. And that's what people are missing, and that's what Alistair was referring to. It's easy to make investments work when finance is so cheap. But when it's not so cheap, it's harder to make investments stack up. One of the things I'm concerned about is not actually so much buy-to-let, but it's more residential. I've heard firsthand from friends who are maxing out really what they want to spend on a mortgage at very low rates, but would be in serious trouble if their mortgages went up 50%. But that's likely to happen in the not too distant future. So beware of that. Now, the PRA rules will help new investors because they get stress test at 5.5%. So that's good news. And actually, for people certainly investing in the north anyway, the ratios and property stress test at 5.5% seem to work. If you're an investor in London now and your mortgage is pretty high, look at it, stress test it, and see at 5.5% if it works if you got your mortgage a few years ago. Investors who've been on trackers since the pre-crash and owner-occupiers could find themselves in big trouble. I'm not worried for podcast listeners, but I'm maybe worried for your friends and family who don't understand this stuff.
Yeah, so people misunderstand interest rates in general. Because they're so used to rates being low, they've been low for such a long time, people might be making dangerous or suboptimal decisions as a result of that. But also, people with longer memories might also be concerned, because there was a period, like Rob was talking about earlier, when interest rates were double digits. The peak in 1990 was 15%. And I know lots of people who had bought their first home shortly before that, and they found their interest rates spiking all the way up to 15%. Very, very painful. What's to say that that's not going to happen again? So interest rates have been really low. They're going to get higher, of course they are. But what happens if they go all the way up to double digits? Well, this is unlikely to happen. The reason it's unlikely is that rates are set by the Bank of England now. They used to be set by politicians. Now, of course, the two are linked. Is the Bank of England as independent as it's made out to be? Probably not. But it does mean that you're not going to end up with rates being changed multiple times within a week like you had back in the old days. Rates are going to climb from where they are. Of course they are. They're going to get back towards the average. We're going to talk about how to prepare for that in just a minute. But the double-digit rates seem unlikely. You also get people thinking that we're in for dramatic interest rate rises because of inflation. Interest rates tend to rise to combat inflation. And there has been a lot of seemingly inflationary pressure as a result of all the new money that's been pumped into the economy in recent years, quantitative easing, which we've talked about in the past. However, I'm not convinced this is going to have a dramatic effect. I mean, there has been huge inflation already. There's been huge asset price inflation as a result of QE and as a result of the low rates, hence lots of demand for assets. But this hasn't filtered down into the real world. This has just been at the sort of the asset level. It hasn't filtered down to consumers and consumer spending at all. So it's not really hit the real world, and it seems unlikely to do so. There's also demographic factors in play. Inflation, roughly speaking, is the result of more demand than supply, and we seem to be moving into an era demographically of lower demand than we've had in the past, which brings its own challenges for the standard economic model. But the point is that because of those factors, there seems to be, to me, little prospect of rates getting really high. So I don't think you need to be worrying about double-digit interest rates anytime soon. But of course, they are absolutely definitely going to go up from where they are. So how should we prepare for those rates rising?
Okay, so the first thing to be aware of is the rises will be mitigated by the banks lending at more competitive rates. And we've seen the banks getting more competitive already. So, for example, your average mortgage product right now, if you're buying in your own name, is roughly 3%. Just over a year ago, it was 4%. And a couple of years ago, it was 5%. Now, rates have dropped slightly, but the reason we've gone from 5% to 3% average, and interest rates have only fallen 0.25%, is not because of that 0.25% has been exaggerated, but it's actually because the banks are getting more competitive. And the margins, the huge margins they were taking, have come down. And that will happen again. When rates start to move up, if people stop borrowing, banks will get nervous, so they'll reduce their margins further to carry on to attract the money. They're a long way off from where they've been historically, and the rates they used to charge versus the interest rates. Their margins were slivers in the past, and they're quite chunky right now, especially in buy-to-let. So that's the first thing to be aware of, and a little bit of peace of mind for you. But that doesn't mean you should relax and switch off. You should stress test at least a 5% across all properties you're looking to buy, and any properties that are in your portfolio right now. Because if you're sitting on any properties that only cash flow because you're on a really low rate, then make plans to deal with that before rates rise again. So don't bury your head in the sand. Look at your portfolio, work it out at 5%, and if it still works, yeah, you might not be rolling in it, but if you're cash flow positive, relax. But if some of your properties are struggling at that rate, then take action.
Okay, so to wrap up, how worried should you be? Well, rates, of course, are going to rise from where they are now, but they seem unlikely to get up to double digits anytime soon. And of course, remember, even when they were that high, it wasn't for very long, so a bit of a contingency fund would have seen you through. But they are going to rise. When they do, it will be harder to make investments add up. So finding value and adding value is going to be more important than ever. You can make lots of investments work when money is very cheap, but when that's no longer the case, you will have to work harder. So overall, should you be overly worried? No, but you just shouldn't be kidding yourself that this is normal. This isn't normal. You need to be planning for rates to be higher. And we've already talked about how you can do that and what sort of rates you should be testing up to. Plan for those rates to be higher, both with the investments that you've already got and any that you're thinking about making, to make sure that you're not caught out and you're badly affected in some of the ways that Rob was talking about earlier. Make those plans, but then enjoy the rates while they're so low. It might not be normal, but that doesn't stop you from enjoying them and banking that extra cash flow while we've still got them.
So don't panic. This isn't one of these episodes to scare you away from property. Far from it. It's just to prepare you. If you do those checks that we talked about at 5%, then you can relax. But don't just hope it's going to be okay. Go and do your numbers. Get that reassurance. And if you need to take action, go and do it. But if you don't, settle down. Get ready for another podcast next week and you'll be fine. When will rates go up? Well, America has been slowly increasing its interest rates. We tend to follow. Article 50 is going to have an impact. There's probably too much uncertainty this year. My gut says to have a rate rise. I'm going to stick my neck on the line, Rob, and say in the first 6 months of 2018.
Oh, and it's not even a predictions episode. You're going there anyway.
I'm going there anyway. Go on. Humorous, Rob. What do you think?
Well, I'm going to give myself a bit of breathing space. I think there's going to be...
the next 10 years.
I think that I'm not going to talk about the timing of a tiny rise back up to 0.5%, because I think the cut to 0.25% didn't really make a lot of difference. It didn't really seem necessary to me. They could put it back up to 0.5% if they want to signal anything, just for a bit of an indicator, a confidence boost, or whatever. That could happen at any time. But just to be a little bit different from your prediction, I'm going to say that we're not going to see any interest rate rises beyond that next year either. Now, it doesn't mean I'm being complacent. It doesn't mean I'm basing my investment strategy around rates staying low, but that's just a little prediction.
I like it. So there you go. Loads and loads of information. A heavier episode than normal, but we get such great feedback from these type of episodes when we deep dive, so we hope you found it useful. And I know you'll find our resource of the week useful, which we'll come to shortly. And of course, we'll tell you what's coming up next week. And while we get told you love the deep dive episodes we do, we love your reviews that follow. So a huge thanks to this week's reviewer who says, guys, have been following your podcast since its inception, and I have to say, it's just as interesting as it was from day one, if not more. Information is always well researched, factual, and presented in an easy and entertaining way. Your podcast launched me into the world of property investment, and it keeps me going. I'm also recommending your podcast to anyone who isn't aware of your awesomeness. Thank you. Brilliant review. And that's awesome that we've not managed to lose our early listeners either, Rob, and that actually they've even better taken action from some of the stuff we've done. We've said this before, but it really, that's the type of stuff that really has an impact on us. When we see that people are actually taking action off this information, we know it's not just us two blabbering on every week for 30 minutes, that people are actually doing something with it, and that is just brilliant to hear. So congratulations to you for getting started, and thank you for sticking with us after all this time.
Yeah, I like how he or she wasn't jumping to any conclusions, or waited 4 years and went, yeah, this is a good podcast, I'm going to leave a review. I like that.
Yeah, I've got a 4-year test on a podcast before I leave a review.
I'm only teasing, Willem. We appreciate reviews at whatever point they come in, so thank you very much for that. Let's get on to our resource of the week. You know I like a good Chrome extension, and we've got another one for you this week. Chrome extensions, if you're not aware, are little extra plugins for the Chrome browser that add extra functionality that you might find useful. This particular one is called Back Again, and I really like this. What it does is it tracks the number of times you visited a page in any given day. So what it does is next to that address bar at the top where you can see the page you're on, it puts a little number next to it. And that number shows the number of times that you visited that page today. What I really like about it is it means you can't lie to yourself. So if you are addicted to a particular website, Maybe it's the news, maybe it's something to do with sport. Hopefully it's the Property Hub, probably it's Rightmove. It means that you're not going to be able to lie to yourself anymore, and that's good for helping you to break habits, because the first step is to realise that you've got a problem. So if you are trying to cut down on visiting a particular website, you could use this little extension to shame you by showing you, and it will also, if you click on it, show you the trends of how many times you've visited in previous days as well. So a nice little bit of extra functionality. You'll find the link to it in the show notes, which this week are at thepropertyhub.net/interest rates.
I don't think I actually want to know how often I visit Rightmove. I'm not ready for that brutal reality yet. Although sometimes it is work. Sometimes. Right, okay, next week we've got another cracker of a podcast for you. It's a subject, unbelievably, that we've not dedicated a whole podcast to. It's leaseholds. What you need to know, how to extend them, and I'm sure this is going to get your attention, how to make money from it. So leaseholds next week, so make sure you join us for that. And of course, we'll be back for Ask Rob and Rob as well on Tuesday. But remember, it is Meetup night. Rob's in Edinburgh. I'm in London. You got 38 others to choose from as well. Tickets are free. It's great fun. If you're on the fence, get off your lazy bum and get along to one.
Yep, definitely do. We'll be very happy to see you there, and we look forward to speaking to you again next week. Bye-bye for now.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.